Welcome to part 2 of our week 3 lesson. The next part we're going to talk about is also part of financial planning, and this is planning for retirement. So there are a few bits of the slide that I want to kind of guide you through. First of all, one of the big issues of retirement planning is, of course, figuring out how much to save. And a lot of advisors suggest that from the time you first start working, so when you're 21, 22, that you set aside 10 to 15% per year of your income. One way to think about this is that you want to have a certain amount per by different age sort of milestones. So this is actually from the Forbes website, and this says basically that by the time you're 35, you want to have the equivalent of your salary invested in retirement. So let's say that you're 35 and you're earning, say, $60,000 a year. You should have a retirement account that has $60,000 in it. By the time you're 45, let's say your salary has now gone up to $70,000. Okay, your retirement savings should have gone up to $210,000 because you want to have 3 times whatever your current salary is. And the reason for this is because you want to ensure that when you retire, that you are able to withdraw and able to live on a certain significant percentage of your current income. And when I talked to Mr. Calls, he suggested somewhere between like 70 and 80% of your current income. Another figure I found had really different numbers depending on what your income was, but the lowest number I saw was 77%. So if your current income, for example, is $100,000, you want to be able to have an income stream of $77,000 per year when you retire. Otherwise, you're going to have to significantly cut back on your living expenses. You have to, eat out less and take fewer vacations and not drive as much. And those aren't necessarily things you want to do in retirement. You might want to actually be able to do more. So these are some guidelines. 10 to 15% a year set aside. Have as a goal to have these multiples of your salary. So let's say your highest income near the end of your life, you're earning $100,000 a year. This would say you want to have $800,000 in your retirement account, which might seem, like a lot or seem maybe impossible. But with the power of compound interest and starting early, it is actually very possible to do that. Okay, a few other things. These are some of the retirement vehicles or investment vehicles you can use for retirement. 401k and 403b are both tied to your employer. A 401k is a private industry employer, so most businesses that you would work for, corporations and so forth, would allow you to contribute to a 401k, and they'll often offer matching plans. So you can contribute, for example, up to, say, 8% of your salary, and they will match up to 4%. So they'll give you some kind of description like that about a matching plan. And the limits right now for people under 50, the most you can put in is $18,000 a year. If you're over 50, you can actually put in up to $24,000 per year. So that's a lot that you can actually put into a 401k at a time. 403b is for public sector employees. So teachers, for example, have 403b plans. They work essentially the same. And often these public employers will offer similar matching plans. The limits are the same. 18,000 if you're under 50, 24,000 if you're over 50. The other two are independent sort of retirement accounts that you can set up that do not, you can do this if you're self-employed. You can also do it if you have a job where you have a 401k. So you can put money into a Roth IRA, and that money is money you've already paid income tax on. So you pay the taxes now, you put the money in a Roth IRA, and that money, when you withdraw it later, you don't need to pay tax on it. And by the way, 401k and 403b contributions are pre-tax. So they are things that take money out of your tax and they wouldn't count toward it when you are calculating. They're not part of your taxable income, so they're not part of what your tax rate gets applied to. Contributions to a Roth IRA are after-tax income. So you pay taxes now, but when you withdraw the money later, when you retire, you don't have to pay taxes on it. Traditional IRAs are like 401k and 403b plans, where you take pre-tax money and you set it aside and put it into an account, and it lowers your tax burden now. But when you withdraw money later, you do have to pay taxes on that money. So the limits for those under 50, you can contribute $5,500 a year to those IRAs, both of them, and $6,500 a year if you're over 50. So, sorry, I don't know why I wrote over 50,000 here. That's supposed to be over 50, like as in your age. Okay, so what happens to this money? When you put it in one of these accounts, you have a number of choices about how that money is going to be invested. So we'll come back to that later, but the point is you put money into one of these accounts. You have a manager, right? Some type of money manager who who invests that money and puts it into stocks and bonds, certificates of deposit, annuities, or other kinds of investments. And then that money grows over your lifespan, hopefully with compound interest, and helps you get to that 800,000 mark or whatever your goal is. Okay, so what is investment? So you can invest for retirement, but you can also invest yourself. You can set up your own stock account that doesn't have to specifically be a designated retirement account. So investment means putting your money in a specific vehicle with the goal of earning returns. These are some really simple rules for investing. Start early, max out employer matches. If your employer offers a 401k or 403b, you make sure you are setting aside enough money to get the maximum. Some employers are throwing in an extra $5,000, $10,000 a year if you're actually putting money into the 401k or 403b. Keep your money invested. Don't pull it out to buy a house or go on a nice vacation. And diversify. In other words, don't put all your eggs in one basket. Keep some of your money in very safe, secure sorts of things, and put some of your money in high risk. Overall, your portfolio, which is like, if you think of the portfolio, it's like a big book, like a portfolio, and it's full of all the different things. So you might have some stocks, you might have some bonds, you might have some money in cash, maybe you have some money in real estate, all these different things. As you get older, you want to move toward more conservative or safer investments. So fewer things that are like junk bonds or high-risk stocks. Okay, so that's the overall general look at investment. Other terms you should know: risk versus return. Risk is, of course, the chance of losing your money. The return is what percentage growth are you going to get? What rate of growth are you going to get? And the higher risk you take, likely the higher potential rate of return. So when you buy money, buy a stock, you risk, of course, losing all your money, but some stocks have made people, multimillionaires. If you owned Apple stock early on, right, then you're wealthy. Lower risk things like buying a certificate of deposit, you're going to get maybe a 1% rate of return. So risk and return are going to be inverse. Front-end load versus back-end load basically has to do with accounts like the IRAs and the 401ks and other things like that. And that is, do you pay the fees up front or do you pay the fees when you take the money out? So front-end load means you're basically paying the person who's managing your money right up front when they put the money into an account. Back-end load, you pay later after you've earned money. And then there are some things called no-load accounts, and that's when you basically go directly to a company like, say, Fidelity or Vanguard, and you don't have an advisor, you just buy into a fund, and then you would have no load. You would also have, of course, less advice. Time and liquidity. The longer the time that you are willing to tie up your money in a particular type of investment, that means you have less liquidity, right? Because you don't have that money available as cash. You tend to get higher returns for things where you have less liquidity and more time. And then present value and expected value calculations are part of this. And rather than going into those with you, I have given you some resources. They're on here, but they're also linked to Moodle. So you'll have some other explanations and sources for looking at those. But those calculations are definitely part of this section of personal finance. Okay, real quick, difference between stocks and bonds. Stock is equity. It's a share of ownership in a company. When you buy a stock, you are one of the owners of that company. When you buy a bond, it is not a share of ownership. It is a loan. So you are lending money to the company. Stocks are much riskier than bonds. However, you can, of course, buy what's called junk bonds or high-risk bonds. And when you buy high-risk bonds, they also offer higher returns. If a company goes bankrupt, goes completely out of business, the bondholders are considered among the creditors. So they're people that the business owes money to, and they are paid back first. And any assets that are left over are distributed to the stockholders. So you have more likelihood of getting paid back if you're a bondholder. So as I said, stocks are equity in a corporation. Stocks, we also use them. We look at like the Dow Jones, right? And we consider that an indicator of economic health. We look at also at the NASDAQ. But stocks really are just a share of ownership in a corporation. And when you're thinking about buying a stock, you really want to know about the actual corporation, not about necessarily the economy as a whole. So even during bad times, some stock value are going to go up. For example, United Health. United Health had no trouble withstanding the recession, right? People who own shares of stock in that company made money. Okay, a PE ratio is a price-earnings ratio, and that is the value per share in the market, which is meaning, like, what is the price of the stock right now? It's $40. And if earnings per share is $2, meaning that the corporate profits are $2. If you take all the corporate profits and divide it by the number of shares, that's $2. Okay, you take the 40 divided by the 2, and you get 20. That's the price-earnings ratio. Dividends are distributed profits. High-growth companies tend not to pay them, meaning the companies that are most likely to have the stock go up in value dramatically are probably not going to pay dividends. More stable companies like General Electric pay dividends. So some people own stock for the purpose of earning dividends, getting some of the profits of the company. Other people are looking mainly for growth and wanting to sell. A little information on the SEC here. I'm going to let you pause and read that. That is the main organization that sort of supervises stock markets. All right, you should also read this section on bonds. It gives a really good explanation of the fact that bonds and interest rates are inversely related, bond prices and interest rates. So I'm going to skip to the second paragraph. Let's say you have a 10-year $5,000 bond, and the coupon rate or the interest rate on that bond then is 5%. But let's say interest rates go up, and new bonds are coming out with a coupon rate of 6%. If you want to resell your bond, you're going to have trouble, right? Because people are going to say, well, new bonds are paying 6%. I don't want your 5% bond. So it will reduce your bond's value, which means that you could sell your bond, but you'd have to lower the price. So if you lower the price on the bond, then the person who buys it from you will realize an actually higher interest rates. And that's why the face value of a bond, I shouldn't say that, sorry, that's why the price of a bond is inversely related to the interest rate. We can talk more about that if you have questions, but again, I would suggest that you pause and read that section. Okay, bonds are rated by a variety of rating agencies, bond rating agencies, and these are the 3 best known ones. You just need to know their names, really. Standard & Poor's, Moody's, and Fitch. And if you see a AAA bond or a AA bond, that's supposed to mean that it has a high credit. It's a quality investment grade bond. You're just not going to lose money on it, right? And if you see a D or a C even, that's low credit, and if you buy a bond in that company, you're really taking a risk. I should point out that during the booming era of mortgage-backed securities, a lot of the ratings agencies gave very high ratings to these mortgage-backed securities, which were actually pretty low quality bonds. So you can't necessarily always trust them, but those are the rating agencies that we use. Okay, mutual funds are a good way to diversify. So you can go out and just buy individual stocks yourself. You can set up a Fidelity account if you want to, and you can say, I want to buy Apple stock, I want to buy Google stock, and I want to buy Disney stock. But you could also invest in a mutual fund, a Fidelity fund or a Vanguard fund, and you can buy shares of their fund, and what they do is they pool the funds of a whole bunch of different individual investors, and then they buy a diversified portfolio of individual stocks and bonds. And you can actually choose, I want a high-risk mutual fund where all of it's going to be stocks, right? It's all going to be risky equities. Or you can say, I want a low-risk mutual fund, and they're going to have a variety of different investments that are all low risk. So it's a good way to diversify. It's easy, and that's what a lot of people do for their personal accounts as well as for retirement accounts. Okay, money market deposit account is kind of like a cross between checking and savings. They earn a little bit more interest, but they don't necessarily let you take as many withdrawals as you could if you had a checking account. They are offered by banks, and they are FDIC insured. So important to know that. They are safe. They don't pay a really high rate of interest, but they're a little bit better than the standard savings account. Hedge funds, you might have heard of these. They are really aggressively managed, and generally they're private investment partnerships, so they're not really open. You can't just say, like, I want to invest in your hedge fund. Usually what happens is a few people with a lot of money get together, and then they hire people to manage their money for them, right? They say, work for our hedge fund. It's a private equity firm. We just want you to manage our money, and we'll pay you a good amount of money to do so. So they use a lot of these interesting advanced investment strategies, borrowing a lot of money to leverage, buying long, meaning they're going to keep their investments for a long period of time, shorting the market, which we can talk about a little, but that's where you sell something and then later buy it, and then derivatives. So that's a little bit probably more detailed information than we really need to go into at this point, but we can talk about it when we meet. And finally, I only have about 30 seconds left, so I'm just going to list this here. Fiduciary means who is somebody answerable to, or who do they have the responsibility for. So when you hire an investment consultant, they should have a fiduciary or a financial responsibility to you. Okay, I'm going to wrap up there, and please bring questions with you.